I want you to quantify the impact of a price for an iPhone approaching $1,000 because everybody wants the fancy iPhone 14 Pro this, Pro that. And I also want you to quantify that $1,000 because the wireless cell phone companies are helping out Apple. We're really not paying $1,000 for our phone, are we?
Yeah, if you had asked me that question 5 years ago, I would have told you no, nobody would spend like $1,000 on an iPhone. And I would have told you, this wireless company is paying for the iPhone, you pay them back with like outrageously expensive monthly price plans, okay? And I would have gotten that completely wrong. What Apple demonstrated is an extremely strong pricing power, an ability to positively improve the quality of their products and get you to pay that. And what you see today is that, honestly, 2023 is a tough year if you sell smartphones. Everybody's suffering in this industry, Samsung, chip suppliers. And what we saw last night is that Apple, despite having cranked up these prices so much, is actually seeing an iPhone business that is not doing great. There is a lot of pressure. Demand is not very good. But on a relative basis, Apple is doing impressively all right, going through the storm relatively well.
If we look at the income statement, I'm going to call you middle of the road here, not a fanboy, not an Uber bull on Apple. Is the durability of that pricing power the heart of the matter? Is that the future for Tim Cook and Cupertino?
Well, I like the fact that you put me right in the middle, because there is one issue with pricing power. You don't get your average selling price going from $600 to $1,000, and then you can't play that trick one more time and again and again and again. So that's the reason why today, the future of Apple is of course to benefit from these very, very strong unit prices and the scale they have today. But the future has to be elsewhere. We don't think Apple can step up pricing a second time. And so that's the reason why, we're very much in the middle of the road and thinking, yes, Apple is a good business, but what's the growth potential of the earnings power of the business now that the iPhone is at $1,000?
This is it, Pierre. This is such an important conversation. What's amazing about Apple, it's the most researched company on the planet, probably. Them and maybe a handful of other ones. And yet still there is this debate about how to value it. What is it? Is it a growth company? You're pushing back against that. Is it a luxury company with fat margins? Maybe, although you're saying we're testing the limits of how far they can push pricing, so they're certainly not LVMH. Is it a staple? Pierre, what is it? What multiple should you put on this name?
This is exactly the conversation we're having with the team this morning. And it's a very, very difficult question. If you look at Apple today, it's trading roughly between 30% and 50% premium on the S&P 500, right? So you pay 30 to 50% premium to buy a business that is showing the resilience they're showing today. So you know that when things go wrong and are getting tougher for everybody, they're getting easier for Apple. Now, you're paying that premium on a business that cannot grow earnings more than 5 to 10% a year on a normalized basis. Even if you are very, very constructive on Apple, unless you get into scenarios of Apple doing a car, Apple really changing the world with an AR headset, they can't really grow earnings more than 5 to 10%. So what's why would you own the stock? It's 30 to 50% more expensive because there is a quality premium, and then it compounds 5 to 10%, 5 to 10% a year. Yes, maybe, but then it's not like a bad deal. I would say a bad value proposition, a bad equity story, but it's not super compelling. And now, of course, John, the question is, could it be worth 2x the S&P or something like that? And here, it's a whole debate of, if you look at the next quarter, the team is going to report in July, for $1 Apple makes with the iPhone, they're going to be making more than 50 cents with services. And Tim said on the call yesterday night, they are approaching 1 billion subscribers. on their products. And so that's where, the premium you pay for, we know the compounding power of Apple cannot really, escape gravity. Like this 5 to 10% is a bit of what they have to live with. But the underlying quality of earnings and things like that is like, it's a difficult question. It's difficult to have like a firm answer.
But Pierre, there is this sort of big elephant in the room, which is the $90 billion of buybacks and the increase to 4% dividends each quarter, given the fact that this is a company that can just afford to absolutely flush the market with cash. How much does that basically push away all of these nice, neat math and sort of valuation arguments and really challenge the idea of a stock going down significantly from here, as your price target suggests?
Yes. So the price target you refer to is not calling for like the stock collapsing for where it is today. It's a price target that we update once a year and give an outlook. So if you put it into the perspective of when we updated it, it's actually a price target that tells you we don't expect much to happen on the stock, to be honest. On the dividend, the buyback, of course, it's boosting how much like compounding you can expect on the stock. But that's the thing, as an investor, you're like, what's my total return? If earnings power, if free cash flow, if all these metrics, revenues grow 5 to 10% a year, that's a 5 to 10% return. Okay. If the company pays a dividend that grows 4% a year, that means my dividend is following that return profile. So it's not additional value to me. And then how much is the dividend as a percentage of the value of the stock? What is the dividend yield? And you see that the dividend yield of Apple, because it's trading on a fairly high multiple, is in low single digits. So you're talking maybe, 8 to 12% total return if you look at how much you get with your dividend and how much you get because the company is growing. And so, as I said, middle of the road, it's not bad. I definitely don't think it's bad. But so you don't have like a significant outperformance opportunity just out of this math. You need more than that, which would be the stock re-rates. It goes from a 30% premium to a 70% premium. Or Apple, virtually almost reinvent itself again with an AR headset or with a car or something like really, really new. These are the things that really would move the needle beyond an 8 to 12% return.